Good day, traders. The 4-step method to high performance trading is a free course download for increasing your competence and your ability to execute your trading edge in live time. The link for the download is in the description box below. And the free audio program, the 7-step daily routine for high performance traders, is also a free download to develop your discipline, your confidence, and a winning mindset to master the markets. Again, the download for these links is in the description box. They're both free downloads. Let's get started.
Good day, traders. Stacey Burke from Stacey Burke Trading. Today we are going to be talking about mastering the high and the low of the day. There are only 3 things that markets do to reinforce best trade setups. Day 1, day 2, day 3, Monday, Tuesday. Monday, the opening range. Tuesday forms the initial balance at the beginning of the week. Wednesday is the midpoint range of the week, heading into our closing range of the week on Friday. Day 1, day 2, day 3, Wednesday, Thursday, Friday. We've recently reviewed these concepts in more detail in the playlist, which I'll show you next, regarding 3-day setups, 3-session setups, understanding day 3 longs or day 3 shorts in the market as signal days, first red day, first green day, and the inside day. These are signal days, and these can become the beginning of a trade setup on the day itself, depending on how that template sets up for either a trend trade or a reversal trade. And for those of you who have just started, again, I have gone into detail on this playlist into each one of the aspects regarding best trade setups, with breaking each part of it down into more detail: the timings, the levels, the behavior of price, the weekly templates, the daily templates, pump and dumps, or dump and pumps. So again, this playlist is everything you need is in this playlist. Each video that I compile here forward will reinforce every simple little concept. So if you have questions, go back, watch these videos. I explain everything in detail as best possible, and I continue to do that. Today we're going to be talking about mastering the high and low of the day. I want to just reinforce a simple concept of asymmetrical risk reward. I want to plant the seed that this is not trying to get the direction right. We're trying to identify the pairs that are set up the best on the day for a 90-10 possibility / probability best trade candidate that can be scaled into. It's a rinse and repeat sizable opportunity. Some are going to just be for session trades. We're going to look at specific examples of those today. And we're going to look at other ones which were 5-star opportunities at the beginning of the week on a Monday. A new month, as I talked about last week, a new month, new timing cycle. Whenever we see a new month, we can see a reversal or continuation trade on a longer time frame. High of month, low of month, closing price, all significant levels. Markets only do 3 things. They break out, they pull back, and they continue. This would be a trend trade. So several times a high or low level of the day gets broken, doesn't get broken, and traders are trying to just randomly sell highs and buy lows when we have opportunities for trend continuations. Then we have other opportunities where a market may break out, pull back, and fail and reverse for an explosive either short squeeze, long squeeze, for a parabolic opportunity. And again, some traders not seeing that in live time. Today, again, we'll look at 2 specific examples, 3 actually, of one of each of these. And then also they can stay range bound between a high or low of a day, and what levels are significant in terms of creating that. There are ones that will be specifically a high of week, low of week level. There are no daily levels broken out of yet. No markets broken out, or some instruments not broken out yet. So just to paint the simple picture again, that there is a template Monday to Friday. Monday is the opening range of the week, day 1. By the time Tuesday prints, in a high percentage of cases, the high or low of the week level may be in place, and one of those extremes will tend to hold. Day 1, day 2, day 3 for either a parabolic trend trade opportunity, day 3 blowing off in the direction of the trend, or a reversal. And sometimes we can get both. And that forms a reset heading into our closing range of the week. Wednesday becomes the new day 1. Day 1, day 2, day 3 into the closing range on Friday. Now this is separate from 3 days of breakout traders in the market or a 3-day setup, which we've gone through in previous videos. in order to make this as simple as possible, I'm just painting that picture again for traders. There's a Monday to Wednesday template, pump and dump, dump and pump. Yesterday's levels are significant. The high of day, low of day, and closing price. I had one person message me and say that I make these levels up. Unfortunately, I don't. These are concrete set levels at the close of the day, New York closing time, 5 p.m. New York time, wherever you're at, Google that. I'm not sure what your chart closing times are. I use New York closing charts. Yesterday's levels are concrete when the new day starts. Those are the levels that the market will trade from or to, or from to from. So, very important to keep things simple. This is reproducible. These levels reproduce into the next day, and that gives me my levels for my template. One trader asked why I don't trade end of day anymore, and if you understand what these levels mean, we are trading on longer time frame daily levels. We're just looking for the best trade candidates on smaller time frames in our timing window, which we've gone through previous in many, many videos. If you're not sure what the 12 candle window is or when the times to be trading are, go back, watch these videos. We repeat that several times over. 9:30 is the New York equity markets open. 8 to 11 a.m. New York time is the U.S. session for me. That's my trading window. 2 a.m. to 5 a.m. New York time for Europe, London. Europe opening at 2 a.m. and London opening at 3 a.m. And then 8 to 11 p.m. for the Asian session. Now we're looking at gold on Tuesday, and Monday the market went parabolic at the beginning of the day. That was the high of the month, the high of the year, the high of the month, the high of the day, coming out of a 3-day rectangle consolidation, which we went over in the previous video. Peak formation high, peak formation low, consolidation for the dump and pump on Friday that blew off parabolically on Monday. Now this breakout coming into our US window collapsed down through the high of the day below closing price. And this is coming into Tuesday, but we'll just demonstrate this process to traders. Peak formation high that came down and made a peak formation low into our 12 candle window. A lower low on the inside underneath closing price, which pumped up, trapping volume into our closing price level before engulfing 30 minutes into our US 12 candle window for the easy collapse down through the low of the day. So a failed breakout. So we have a market that broke out, broke down back inside again. It's broken out and then broken down below closing price, pumped up for the parabolic collapse down through our low of the day. Now also just come back and demonstrate this also. This breakout of Wednesday's high has now come back inside right at the New York equity markets open. We'll bring this back. Right at the New York equity markets open. So this lower peak formation high is indeed the New York equity markets open. It breaks down back inside of Thursday's high of day also, which will just project this level across for the continuation trade at the New York Open. So for traders who did not enter into this first hour trading opportunity, the market pumps back up in an already broken down market for the low-hanging fruit continuation trade in the New York session. Now, if we bring this, zoom this back out, we have a market that's now gone into breakout, and it's closed in breakout, heading into our day 2, Tuesday. Now remember, we said markets only do 3 things. They break out, they pull back, and they continue. They break out, they fail, and they reverse, or they stay range bound in the trading range. Now we project these levels across. We can use high of day. So we have a market that's broken out and pulled back. Now we'll just project also closing price across to show traders that these levels, I've received this question quite a bit. I notice you project those levels across. Why is that? Well, remember, these are static levels. So tomorrow when the market is trading, you're going to hear on the news that the market's up 2.5% or it's down 2.5%. That is relative to the closing price. So if this market was major support, I don't care if people want to call that a support, an order block, supply, whatever. I don't care. It doesn't matter. It's a level. There's only 3 levels I trade from. But more importantly, this market broke out. It is in breakout. It's pumped up into that level. If you were short at the closing price of the day, let's zoom in here and think about this psychologically. If you were short at the closing price of the day, all the way until the market gets back here in the London session, you're underwater if you haven't been stopped out already. And you'll notice that little pump up also goes back up into our New York session, low-hanging fruit continuation trade. But once this market breaks back down, the trader who's short at the closing price, as Paul Tudor Jones says, imagine your entry point is last night's close. You feel better about yourself, but we haven't taken out the low of the day. And some traders misunderstanding the concept of being inside. Once this market closes below yesterday's low of day, you are still now out of balance. You are still in the breakout. It is in breakout still. Understand that. This market broke out. Once it closes below that level, the low of day level from Friday, this market is now still out of balance. You're below the closing price or the low of the day price. Then we get our little template. So one of the questions that is frequently asked again is, what do you mean by a well-engineered template? What type of price behavior on the day are we getting? Is it a peak formation high, peak formation low consolidation? Or is it peak formation high, breaking down? This market breaks down. That's like a death candle and a neckline before pumping back up. If a market coils sideways without taking out the low or the high, it's getting ready for an explosive move. Now, this is a really simple setup. This is pump and dump into closing price level before we get our engulfment, beginning of the second hour. Timings, levels, behavior of price. Escalator up for the elevator ride down before major red news. So this blows off into the New York Open. Another excellent question from a trader was, why did you get in before 9:30? Okay, so listen closely and I'll repeat this. Anything can move in the first hour. Primarily indexes open at 9:30 New York time. And on the odd occasion, as we saw yesterday, when we get a breakout, a market that has already broken out, it has already broken out. It is in play. The market may give us a first hour trade opportunity. On all the other instruments, gold, oil, currencies, we can have first hour trades. Now, this market has pumped up for 1 hour, 30 to 45 minutes, beginning of the hour. So this peak formation low was put in the London gap time. And we'll zoom in on this in a second, but I want to just paint the picture. We'll just back this up. The market is already below the low of the day level from the previous day's breakout. It's already still in breakout. Trend continuation, breakout, pullback, peak formations are up, pump and dump template for easy free cash on day 2. Day 1 breaks out. Day 2 continues in the direction of the trend on this particular template. Now we had major red news, but we'll just print the levels and the range expansion tool. Where is your consolidation? Consolidation is between low of day and closing price. My target on the range expansion then, when this market breaks out, is the 100% expansion of the range. Now we'll look at this on a smaller time frame for the first trade and the second trade opportunity that occurred after major red news. Now we're looking at a 1 minute chart. The closing price of the Europe-London window was at 50, and the market was already elevating and moving up from the low of the day in London. So coming back to a simple understanding, another trader asked, why don't you use 3 levels anymore? It's always there. It's there every single day. I can spend 2 hours on every concept, but remember, it's there. That's what the pump is. If it was a dump, it would be 3 levels of dump. We've started down at 25. There is our current low of the current day, but our low of day levels, our market is already in breakout. We're below yesterday's low of day price. I made an annotation on the community page on the post that there was space. So if this market was to collapse through, it should do so quickly, which we did see it do. So we have our second hour entry. This is the 1 minute. Second hour entry, no stress, zero heat right off of closing price. So just reinforcing there's only three levels we're trading from. It's either going to be a trend continuation, and in this particular case, the market broke down, so it's a pump and dump template. And then we had major red news. The New York Open coiled and exploded through our space. There's an opportunity to take money off the table. We're ending the hour. We're heading into major red news. I'm taking the money. I repeat. So some other questions regarding, some days you trade the news, some days you don't. I don't trade the news. I'm out of the market before the news. Go back, watch all the videos. I am never in the market when the major red news is released. I will trade after the news. How long will I trade after the news? Up to 1 minute. And there's 4 types of 1 minute news candles that I will look for. But it has to be in line with a longer time frame best trade setup candidate. So when this market reverses on major red news, it trades into our trapped volume. Notice how our neckline for trapped volume, the closing price of Europe London, traps the volume above. When New York opens, where does the market spike to on the major red news? The high of the New York session, and it engulfs, which several traders took. Repeat, 1 bar stop. It's a 1 bar stop. Why is that? Because if it goes up, I'm wrong, and I shouldn't be wrong. If this template is going to be a continuation trade in line with our range expansion, remember what we said? Levels, low of day, closing price is our consolidation. If it breaks down, it should complete a full range expansion for a measured move target. That engulfment reverses. Now think if you bought, this is the easiest way to understand this particular setup. No wicks, no wicks on either side. It's a first bar trade first bar movement, that stops out the New York Open shorts before engulfing off of our trapped volume ceiling. And now our first bar entry person, who's counter trending a day 2 trend trade, is caught. The engulfment traps the first bar trader. So understand that if people buy this up high on an explosive candle, they are now caught. And this market continues to fall and collapse sideways before exploding down through the low of the day and completing our measured move range expansion profit target for easy free cash. 2 trades if traders decided to trade this. But coming back to the bigger template, we'll just back this up. Day 1, day 2, continuing in the direction of the trend. This particular breakout failed, came back inside, pump, 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 a pump and dump template in a broken down market. Day 2, pumps up into our low of day level breakout before collapsing down below closing price. I'm trading the US session, so hindsight pays. Hindsight is what will pay you the big bucks. Breaking down and then pumping up into closing price level without taking out the low of the day, continuation trade through the low of the day. And as several traders noted, first red day, which yes, indeed it is. It was a peak formation first red day of the month. And also, if we just back this up again, we'll just scoot sideways, you'll notice that that market now was potentially targeting where that pump began on Tuesday last week, taking out the low of the day where our pump candle began on day 2 before the consolidation and the day 3 blow off at the high of the month, high of the year, at the beginning of the new month, December. So larger pump and dump template, failed breakout, a breakout now that pulls back before continuing on day 2. Similar collapse on Monday on the S&P 500. The market made a peak formation low on a failed breakout on Monday. So the market broke out and pulled back and closed inside. So similar to gold, it broke out, but gold stayed broken out. So when we look at the S&P, what we see here is a market that's broken out and pulled back inside. And the high, one trader asked, I had peak formation high drawn here, and that is because when New York opened, it pumps up and dumps down. This was our peak formation high of the New York session. New York equity markets open at 9:30. It made a higher high into the close, and that was our high of the day. That high of the U.S. session day broke down below this trap volume, making that a peak formation high. So that is our high, that is our low. Now, if we just back this up, just real briefly to paint a bigger picture for traders, we have a market that broke out on Wednesday, dumping down, and then on Friday made higher highs and went parabolic on Free Cash Friday. That peak formation high level in the U.S. window pumped up into, actually we'll bring this a little higher, into Thursday's high of day. So that was our breakout on Friday that failed, and they made a peak formation high into the close of the U.S. session. This is a 15-minute chart. The market dumped down and made a low of the day in the Asian window. That low of the day level is in a market that's broken out. So remember, we broke out of yesterday's low of day level. Traders are waiting for it to break out today. We're already in breakout. Markets breakout, pullback, and trend. Breakout, pullback, and reverse for failed breakouts. And so we have a market that has made a peak formation low on the day itself and dumped down into that level again in our London window. Now remember, I'm coming to the screen for the New York equity market open. We have a market that is out of balance. Where is our trapped volume? Where is it at? We have three levels to choose from. We have a low of day, we have our closing price level, and we have our new low of the day level. We have a current low of the day level. We have a low of the day from the previous day's level. We have volume trapped below closing price and jamming into the peak formation low. The market goes parabolic off the low of day level. Peak formation low that failed breakout. They dump it down into that peak formation low. Engulfment, pin hammer, 9:30 New York market open. A second pin hammer at 9:45 a.m. The close of the hour, right at the close of the hour, heading into our major red news. So although there was major red news, the template was there for a larger time frame setup, etc. We have a larger template. We have major red news. The market does a full range expansion through the high of the session, the high of the day from last night's New York equity market close before pulling back inside. Breakout, pullback, back into the breakout level. We're below the low of day level. It's in breakout, but they're jamming it into the peak formation low for the explosive short squeeze reversal on the SP 500. Parabolic short squeeze on page 90. There are two types. There are session short squeezes, and then we have 5-star parabolic short squeezes also. So now in this instance, we can call this a market that broke out, pulled back, and reversed a failed breakout. And we can look at the NASDAQ also. It gave a short squeeze reversal. Monday, day one, breaks out. So we have a market that's broken out of Friday's low of day level, higher high, similar to the SP 500. This is the peak formation high at the New York Open that went higher before dumping down into our peak formation low. So the market makes a low of day on Tuesday, day two, but it trades down into our peak formation low. So this is where traders think that they're inside. They're inside the high and low of the day. The market is broken out of Friday's low of day level. It is still in breakout. Now, here's a great question. I didn't say this on the gold or the SP, but are they working the high or are they working the low? Are they working the high or are they working the low? If this is our peak formation high heading into our close of the day, so an excellent question from a trader was, well, why did you mark that off? The peak formation low of day was made in the U.S. window, and into the close, it took out the high of the U.S. session, and that is our peak formation high. Why is that? Because it traded down below all this price action. So that is our new high made in the U.S. session. And what I should say is that is our most recent peak formation high made in a session. And for this particular setup, we're looking, are they working the low or are they working the high? Now, where is our consolidation? Where is price trapped during the day? It is trapped below our levels. Our low of the day, our closing price level and our low of the day level, which is trading into our peak formation low of the breakout. The market has broken out. It stayed out We're currently outside of the range. It closed outside of the range and traded down into our low of day level. And you'll notice that the bulk of the price action is trapped below 50% of that range. Our pin hammer is right at the open of the New York equity market session. We're on a 15-minute chart. As I mentioned, I will go to smaller time frames at the open when I have a larger template thesis in place, because I'm going to get in as tight as possible if I have an opportunity to participate in this market. An explosive parabolic short squeeze reversal on day 2, a market that broke out, pulled back, and reversed. Failed breakout. We're back inside of Monday's range, about to close in 5 minutes, and we have a day 2 parabolic reversal trade. So master the high and the low of the day. Understand when you have a market that has broken out or when you are inside of a range. But this is a fantastic template. If we look at the DJ30, you'll notice we are inside of a high and a low from Friday's closing range. So I re-emphasize the importance. We've talked about this in several other videos because traders have asked, well, how did you get your day count and everything? And I'm just talking about Monday, Wednesday, Friday for now. And we're talking about markets that are in breakout. It broke out on Friday, and we have traded inside of Friday's range ever since. The high of day from Thursday, and Monday was an inside day, and we were inside the high of day, low of day, and closing price levels are, we have a large consolidation building underneath the closing price levels, but nothing was in breakout. We're in a trading range, and my responsibility, as I repeat, is to try and identify the best template on the day. Why did I choose S&P over NASDAQ? Because I just chose it. There's no particular reason, right or wrong. I like that template. I thought it was going to give an explosive move. You could argue that NASDAQ was cleaner, but they're both clean templates, as was gold. Breakout, pullback, continuation, easy free cash, out before the news. If a trader so chooses to re-enter, and I will often trade gold on news because it moves, and we had a measured move potential as a range expansion profit target on that trade. Next, we will look at oil. So we have a market that broke out on Monday, day 1, broke out of Friday's range. It's already in breakout. So the question I always ask traders is, who's in the market? Not just looking at the high and low day of the levels, but what trade opportunity do we have? Yesterday, we had a low of day parabolic reversal trade right in the New York session for a session scalp. The difference being for traders to understand this, if I am to take a trade like this on Monday, it's a session trade because I'm trading underneath in a broken down market. I'm not expecting this to go all the way back up to our parabolic, Friday, day 5 level or anything like that until we see a break in structure on the inside. Break in structure is what? No, it's not little pushes. It's the break of a daily level. We want to see a higher high on the inside for a dump and pump template. Until I see that, this is a session trade. So when we come into Tuesday, day 2, we now have a market that has closed out of balance, right? So we've closed outside of the range. It broke out. Where's our closing price level? It's below the low of day level. We have our peak formation high and low made in our U.S. window, which coming into the new day may be significant because the market is trading below the low of day level. It is in breakout. Breakout, pullback, continuation trade in our London window into our New York US 12 candle window open. Several traders hit that trade at the low of the day right off the bat back into closing price. On a smaller time frame, we got a little W pattern. We'll just zoom in on that. So we have a market that is still broken out. So traders are looking and saying, in this part, while we're inside still, this has broken the new low of day. So there's a lower low now, lower low on the inside. Why is it inside? Because we're making lower lows on a broken down market that's already in breakout day 2 for the pump and dump. So we have a W formation that gives traders a long trade, second hour, right at the 9 a.m. open. For the pump up back into the high of the day, we get a death candle. What is the death candle, Stacey? That's the large engulfment candle that locks in the high of the session, the high of the day, trapping volume. So they stop out the higher level longs. You'll notice the bulk of all these candles are up top. They trade below that into closing price level before revisiting that high of day and collapsing later in the session back to low of day. So the trade for traders to go along, there was the first hour opportunity, then the 9 a.m. W formation at the low of the day, the low of the week, for the parabolic move back up to the high into our breakout low of day level underneath closing price from Friday. Death candle, third hour, and then the collapse from the high of the day session. So we have volume trapped up high. One of the things that I will say about this is that I would have only been in one trade, either on the way up or on the way down. Now, when you get a template like this is where traders can get chopped up. They chase the move. They're on top of closing price. But if you're taking this trade, understand that when you trade into this level, this is a death candle, and you're looking for possibly that continuation through for a reversal on day two in a broken down market, that you should be at break even if you're in this trade. Now, I don't see this because you're buying up high. But down low, again, no matter what time frame we're on, this is a 5-minute chart. It's a 1-bar stop, whether you're trading it down here for the move up to closing price level, or you're trading it here on the 9 a.m. trade back up through to the high of the day level. It's a 1-bar stop. And when we get up here and we're 1 push, 2 push, 3 pushes into the high, a new hour, are they working the high or working the low? In this particular case, they're now working the high for the parabolic collapse back to the low of the day on day two. And you'll notice this market has closed below the low of the day again on day two. It is out of balance. Day one, day two, still closing lower lows on day two. Oil. So day one breaks out, pulls back, continues in the direction of the trend, gives a parabolic reversal trade, second hour, first hour and second hour, before continuing the trend later in the session. Now, I just want to highlight some different examples of when I will avoid a market, but also to understand the daily levels. We had a market that broke out on Friday, continued to break out on Monday on the Japanese yen, before trading down into the low of day level, pumping up New York Open and dumping down into low of day closing price level and going parabolic into the close. So a market that broke out and pulled back and reversed. Hence, we could call that a failed breakout. Day two, so we have our peak formation high made in the U.S. session, a peak formation low made in the U.S. session into low of day closing price level. Projecting those levels across now, what level are they working? Are they working the high or are they working the low? So this is where traders get stuck. They sometimes are chasing this move when they're trading down into these levels. They're working the low. Are they working the high or are they working the low? Dump, 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 pump it up, dump it down into the news, pin through the low of the day. So an opportunity potentially to be buying low for a session scalp back into closing price level. Understanding what your risk reward is on this trade, we're looking at approximately 40 pips from this space. So another important thing for traders to be aware of is that if you are taking a trade, what is the potential risk reward on these levels? So you'll notice I'm using level and level, or closing price and closing price. Where is the low of the day? It's down at the low of the day level from Friday. Where is our consolidation? So if I'm buying low, I want to be buying down at the level. When? After they have gone through this level, we're into the third hour. We'll zoom in on a smaller time frame. Does the market give me an opportunity to buy on a 5-minute chart similar to the indexes at a level? So we're looking at levels. I want to get filled at or best fill price as I can to the level, being aware that this trade could fail at the high of the session, our closing price level, 1-bar stop targeting 30 to 40 pips. The point I'm making is just as a template now, we have day one, day two, it was a first green day, is a buy low trade setup. Now we're still below closing price on this day, but we still may see a first green day opportunity as this new day evolves. What would I want to see? Higher highs for a dump and pump style of template that potentially could be taking us back up to a high of day level. Remember, daily levels. We have breakout traders in the market that failed and reversed. We are still on top of Thursday's low of day level. The market broke out on Friday. Okay, we're still on top of that level. Volume is down low. We could be trading into this peak formation low before breaking a high of day level, dumping down and pumping back up. Don't know. Have no idea. We may see just the opposite. This market could break down and roll over. Day 1, day 2, day 3 could go back through the low of the week, the low of the day, which is why I repeat, timings, levels, behavior of price. What we can have a signal day, we can have a thesis. What type of template are they going to give me tomorrow? What happens if they dump this down, Stacey? You said it was a first green day. They might dump this down and pump it up into these levels for a parabolic collapse on day 3. Don't know. Find out when we get there. We have major red news on the calendar. ADP, non-farm payrolls, and we have a non-farm payrolls week. Point I'm making is coming back to the daily levels. This is your consolidation. Okay, so I don't mark off zigzags everywhere. Let's go back while we're here. We have a market that breaks out on Friday. We have a market that breaks out on Friday. Day 1, day 2, day 3. Breaking down on the inside, pumps up into closing price level. Where is our consolidation? Where is our consolidation? It's between high of day and the current high of the day on the day. We have a consolidation that breaks down on the inside, lower lows, pumps up, but our volume is trapped up top. Our target is a range expansion and the low of the day level. Breakout that fails. A breakout that fails on day 3, day 1, day 2, day 3. What type of template did they give us on the day? Was it a dump and pump? It was, but it broke down and pumped up into that level. The levels were inside, below our consolidation. Consolidation is above the high of day breakout and below the current high of day. We could even say, for simplicity's sake, we can take our high of day, low of day for one full range expansion. That's a rectangle, a price rectangle. It's a failed breakout. We're targeting the low of the day. We have a trap volume up high or down low. Are they working the high or are they working the low? Here's the low of our week. Here's the high of our 3-day setup. Day 1, day 2, day 3, Wednesday, Thursday, Friday for a measured move range expansion. We had a market that broke out on Wednesday before pulling back inside and stayed broke out until later in the session and into London, right? Breakout traders in the market before reversing. What type of template did they give us on the day? A higher high on the inside. A higher high on the inside is a dump and pump template into our New York Open, U.S. session, a 12 candle window New York Open. A dump and pump template. We had a breakout that failed, dumping down into our level, trap volume down low. Where's our consolidation? It's down low. We can target our high of day, low of day, closing price level to low of day for a range expansion opportunity, breakout pullback. On that particular day, on the day itself, we have a market that's broken out and pumped up. Traders shorting this now are shorting it from the high of day into our closing price level. So again, a poor quality setup on Tuesday. A market that's broken out, Wednesday. Day 1, day 2, day 3 pumps up, shorting down into our low of day level. But major red news becomes our reset into our peak formation low. Higher high on the inside, peak formation low. They dump it down into our peak formation low as we just saw in the SP 500 before going parabolic in London and dumping down into not only our current closing price on the day, but from Tuesday's closing price level for the parabolic reversal dump and pump template on Thursday. So these levels are critical each and every day. Once a market breaks out, it is now in play. Lower low on Tuesday. We broke out of Friday's range on Monday, stayed broken out, breakout, pullback, continuation trade on Tuesday, day 2. going down into our blowing off on the direction of the trend, putting in a peak formation low on day 3, and dumping down in our US session window, higher high. Once the market breaks outside, it's in play. That makes a higher high on the inside. Breakout, pullback, continuation, day 1, day 2, day 3, parabolic reversal trade, which is actually a trend continuation trade in line with our larger time frame template. Study these levels, traders. Markets only do 3 things: Monday, Tuesday, Wednesday, Wednesday, Thursday, Friday. These templates are there: first red day, first green day, inside days, day 3, breakout traders in the markets. Keep it simple. Master the high and low of the day. Understand the timings, the levels, and the behavior of price. Keep it simple. Keep getting better, and may the markets go with you.